lot of our listeners want to understand, so we talk a lot about these other asset classes, and they feel stuck. They feel stuck because they're doing what their broker is telling them to do, or they're just doing for them. Technically, they're already managing their own portfolio.
Correct.
But how are they successful managing their own portfolios? They're self-directing, right?
Correct.
Explain what that is, because these are all available to us as well, the public.
Yeah, and that's really important, because if you are not self-directed, in other words, if you don't have a self-directed IRA or Roth IRA, and you're just concentrating and counting on an employer-sponsored retirement plan, the assets that we were talking about are not available to you. There's limitations, and that's the problem with one of the reasons, I guess, that we have a retirement crisis in this country. People have a limited access to a variety of things that are available outside of their employer-sponsored retirement plans. In those plans, typically the choices are mutual funds, maybe some exchange-traded funds, which is like a mutual fund, or maybe some individual stocks, but all geared towards a one-directional kind of situation where you only make money if the market or the asset goes up in value. The reason that so many people set up a self-directed IRA, and the way that the institutions and the pros do this, is to have this kind of a portfolio that you control. You eliminate fees, which can have a huge negative impact on the overall returns that a person could have. So you eliminate the fees. In those self-directed accounts, you can trade futures, forex, options, still stocks if that's what you want to trade, mutual funds if that's what a person desires to do. But the other assets are available in these self-directed accounts, which means that you can have better diversification, true diversification, because with the leverage, smaller amounts of money can be put into this individual trade, giving you the opportunity to maybe have 2 or 3 or 4 instead of one mutual fund. You get that great leverage, the trading 24 hours a day, but they can also be used in different markets. They're not one-directional. So you can use all futures, forex options in up markets, down markets. Options are a great asset to use in a sideways moving market, where really the market isn't moving, or is just moving within a what we call a range-bound type of a situation.
Now think about this. You mentioned the fees. I mean, for 2020, the market is technically down a little bit still. So the average investor probably hasn't had a whole lot of return, but here's what they're still paying the fees.
Right.
So think about that. If the successful are removing fees, or at least lowering them, that could be a big difference over many years. So if people are in their 30s, 40s, 50s, even 60s, and they're doing their investing, think about the difference in returns that because of the fees.
Correct.
That's the problem, and that's one of the key things that, and I know you talk a lot about in these investing classes, is those fees as compounding in a negative way.
Yeah, in that investment class, come into that class and we'll show you what the impact of fees can be. Even a fee as small as, say, 2%, and a lot of people just assume, well, that's just the cost of doing this, I'm okay paying that. I think your thinking will change when you see what the impact of those fees can be. And the problem is that, what are you getting for the fee? What kind of advice, what kind of counsel you're getting? In an employer-sponsored retirement plan, probably none to very little. And so you're basically managing your own assets in those accounts. Why not do it in a self-directed account where you don't have the fees and you have many more choices?
Yeah, and that's a key word right there. That's one of those C words, choices.